bond valuation. This is also something concerned with valuation of security. Obviously, bond is also a security. A bond means a debt instrument issued by an enterprise or by government. And this is what is more important. It's always a debt instrument, and therefore a debt carries interest. Interest is normally referred as coupon rate in bonds. So in bonds, if somebody says coupon rate, you should understand it is nothing but the interest rate. The feature of a bond is coupon rate. Like any debt instrument, there is a redemption period. There would be a redemption date. For maturity of a bond or repayment. Of a bond. The coupon payments or the interest payments, that is interest payments, can be annual, which is normal, every year interest can be paid, or semi-annual, or quarterly, or monthly. So there can be monthly interest payments, there can be quarterly interest payments, there can be semi-annual interest payments, there can be annual payments. The manner in which the interest is paid on a bond, that is coupon payments, is very important to understand beforehand. Is it annual or semi-annual, quarterly or monthly? Because this will affect the value of a bond, because the present value of a bond with annual interest would be different than that of a semi-annual interest, despite the fact that coupon rate is the same. The annual coupon rate may be 5%. If it is paid every 6 months or 2.5%, then valuation of an annual bond with 5% interest would be different than that of a valuation of a bond with coupon rate of annual 5% but paid semi-annually at 2.5% every 6 months. Therefore, understand when the interest is being paid. Is it annual or semi-annual, quarterly or monthly? And accordingly have this understanding for sure to ensure that the concerned bond is valued appropriately, taking into account the manner in which the coupon payments or interest payments are paid out. So the feature, it's very similar to what we normally call as debentures. Bond is normally a very long term sort of a instrument, and therefore a bond is very similar to a debenture or a debt instrument. It is normally issued by government, it can also be issued by big businesses. It carries interest like a debenture. In debenture we normally refer the interest plainly as interest itself, but here we call it as coupon rate. The coupon rate or coupon payments would refer to the interest. There is also a redemption rate applicable for a bond, at which point of time the bond is repaid. These are all the features of a bond. There is nothing much difficult to understand here. Having said this, similar to valuation of security, bond valuation fundamental, value of a bond or value of any security today would be is equal to present value, like we did for a share, present value of all cash inflows or income streams expected out of investment in bond plus present value of redemption amount or sale value at the end of holding period. We have completed a problem where an 100 of dividend has been collected by investment in a share. Then for some time it was 100, later from 5th year to 7th year it was 120. In fact, the previous problem on valuation of a security where one Mr. A was to purchase a share at 500 rupees, par value being 100, dividend is 20% for 4 years, then there is a bonus issue. There we computed all the cash inflows expected by investment in a share, namely the dividends per year, then the bonus share and later sale of all shares at 900 rupees less of expense and all that. Like income stream being dividend in a share, it is going to be income stream being cash flows or interest or coupon payments. So for the investor, the coupon payments or interest payment is a receipt. For the company, the coupon payments or interest payment is an expenditure. Discount all those coupon payments to its present value at desired rate of return of the investor. Discount the redemption value also at the desired rate of return. Add all this up, you get the value of bond. This is the fundamental of any valuation. The discount rate is return expected by the investor in bond, referred as yield to maturity, what we call as YTM. So in bond terminology, there is something called YTM, which is yield to maturity. The yield to maturity is nothing but the return expected by the investor in bond. If that rate is taken and if all these inflows expected are discounted at that rate, then the sum of all those present values, namely the regular income streams plus the redemption amount, discounted at rate of return expected by the investor, which is what is known as yield to maturity for the concerned investor, YTM, and that value is value of bond today. Therefore, incidentally, while you do this, you also understand something like yield to maturity. If value today and all income streams are given, the discount rate that you will understand given the value today and given the interest payments or inflow streams and the redemption amount, the discount rate that you will apply to equate this and the right hand side would be the yield to maturity. Therefore, we will be doing problems maybe to understand value of bond today, and further given the value of bond today and the income streams, the discount rate applicable which is to be applied to calculate present value, and that will be the yield to maturity. We will now take up some problems to understand the issue with respect to bond valuation, where we would be calculating the value of bond today, or given the value of bond today, we will be calculating what is called yield to maturity. Therefore, given yield to maturity and all this income streams, you can calculate value today. Given value today and all income streams, the rate at which the value today is equal to the present value of all income streams, that rate is referred as yield to maturity. Therefore, calculation of yield to maturity and calculation of the value of bond today would be alternatively done in problems. Either given this and other income streams or interest payments, you will be calculating yield to maturity, or given yield to maturity or the rate of return expected by the investor, and all interest receipts and sale value receipt or redemption amount, will be calculating the value of the bond. So solving for value of bond and solving for yield to maturity would be a major issue in bond valuation. There are certain other issues in bond valuation which we will take up later, but we will do some problem now to calculate what is called yield to maturity or value of a bond today. We have taken up two problems on bond valuation. The first problem reads like this: a rupees 1000 par value bond is a debt instrument. barring a coupon rate is interest rate of 14%, matures after 5 years. If nothing is appended, normally interest rate are quoted on an annual basis, and therefore this is 14% per annum, matures after 5 years. The required rate of return on this bond is 13%. Calculate value of bond. Value of bond today, this is fundamental equation for valuation. For that matter, value of any security today, present value of, I repeat, this we have already seen, of income streams. So I look at everything. The equation is from the point of view of the investor, where this is his outflow. So somebody who is planning to invest in this bond has to spend this much of value today, therefore it is outflow in anticipation of income streams, that is interest payments, or what is popularly called as coupon payments, plus present value of redemption price at the end of the period. Here it is 5 years, matures after 5 years, and therefore at the end of redemption period, that is after 5 years, what is the redemption price? The present value. The present value is based on yield rate or what is known as yield to maturity or rate of return expected by investor. So value of bond today is present value of all income streams, that is interest payments or coupon payments or interest receipt for the investor. Coupon receipts for the investor, this will be a receipt. The expenditure is what is paid to acquire the bond today. The income is periodical interest collected by the investor. The redemption price is also income collected by the investor. All these are discounted to today's value at the yield rate or the expected rate of return, or what we call as yield to maturity, and that is 13% given in the problem. We are trying to work out LHS given the facts as to RHS. The income stream expected from this bond, if you invest 1000 rupees in the bond today, which is what we are trying to understand, or each year out of the investment that you make today, which can be more than 1000 or less than 1000 or equal to 1000, would be coupon payment of 14%. First year you will collect 14 rupees of 140 of interest. This is interest first year, and you obviously understand that 140 will be collected at the end of first year, and the present value of that 140 of interest that you collect at the end of first year, which is 1000 into 14%, interest is on par value always, and therefore 1000 into 14% is 140. 140 interest first year, that is 1000 into 14%, is discounted at 13%. This is present value of first interest receipt. The second interest receipt is again discounted for 2 years. The third interest receipt is discounted for 3 years. The fourth interest receipt is discounted for 4 years. The fifth interest receipt is discounted for 5 years. And at the end of fifth year, they have not given anything. It is presumed that you will collect the par value of 1000. Redemption price is taken to be 1000. And that is your income stream or inflow at the end of fifth year. The value today is discount value of all these income streams of interest every period and the redemption price at the end of fifth year. So 140 by 1.13, 140 divided by 1.13 whole squared to the par 3, par 4, par 5, par 5 again. This is nothing but the present value of all interest receipts plus the present value of redemption price. The value at which you will buy the bond today or value of bond today is discount value of all these income streams for the investor, namely the interest receipt and the redemption price. This discount value will depend upon the present value interest factor for 1 year, 2 year, 3 year, 4 year, 5th year for 13%, which again could be understood from the table. If you look at the table for present value interest factor, for first year at 13%, for first year it is 0.885. This is the figure of interest payment, 0.885. Present value interest factor is one single amount's present value. Therefore, I am looking to single amount present value table, where at 13% the first year factor is 0.885. 1 by 1.13 is 0.885. 1 by 1.13 is 0.885, and therefore the present value of first interest payment is 0.885. The present value of second interest payments, the second year discount factor is 0.783. The third year discount factor is 0.693. The fourth year discount factor is 0.613. The fifth year discount factor is 0.543. And further, the redemption price is also multiplied by the fifth year discount factor, which is 0.543. 140 discounted to present value at 13% at a discount factor of 0.885, which is applicable for 13%. Like that, second year discount factor is 0.783, third year discount factor is 0.693, fourth year discount factor is 0.613, fifth year discount factor is 0.543. That will be taken for the purpose of discounting the present value of final coupon payment or interest payment plus the redemption amount of 1000. Therefore, all these are nothing but, the summation of all this is nothing but the present value of all coupon payments and the redemption price, which is what you attribute as value of bond today. And how much is this? 140 into 0.885. 123.9 exactly. Okay, plus 140 into 0.783. 140 into 0.783.
109.62.
109.62 plus 140 into 0.693.
97.02.
97.02 plus 140 into 0.613. 85.82 plus 140 into 0.543.
76.02.
76.02. 1000 into 0.543 will be 543. The present value of first coupon payment of 140 is 123.9. The present value of second coupon payment is 109.62. Like that, third is 97.2. Fourth coupon payment 85.2. Again, fifth year coupon payment is 140. Discounted for 5 years, it is 76.02. Fifth year end, you also collect as an investor the redemption price, which is presumed to be par value because they have not given anything. 1000 into 0.543, 543. The total of all this 1035.38. The value today of the bond is 1035.38. The par value of bond is 1000. The par value of bond is 1000. The value today is 1035.38. That is what is asked for. Calculate the value of bond. The value of bond is 1035.38 rupees. The further issues that could crop up beyond the answer required would be, having understood this figure, if the bond is issued at 1035.38 or less, if the bond is issued at 1035.38 or less, the intrinsic worth or the value of this bond is 1035.38. An investor is to acquire this bond. The worth of the bond or value of the bond based on this fundamental rule of valuation, where any securities value today is present value of income streams and the redemption price or the sale price that you collect at the end of holding period. That seems to be 1035.38. This is the maximum price that you could give for the bond. If the bond is issued at 1035.38 or less, you will acquire the bond. Otherwise, you will obviously not acquire. You will pay more than par value of 1000, which is par value. Here it is 1035. You can pay more than par value because your expectation is 13%, but the company gives 14%. The bond issuer is paying out 14% at its interest, but your expectation is only 13%. A collection of 140 every year is interest on 1035.38 will work out to something like 13%. 1035.38 into 13% will be close to this 140, notwithstanding time value of money. And therefore, if you invest 1035.38, your expectation of 13% will be met, because what you get is 14% on 1000. And therefore, the bond is could be priced at a premium, or the bond could be floated or sold at premium. The figure is 1035.38. The bond may be issued at a premium of say 35.38 or lesser. But then the question is to calculate value of bond. We have all the ingredients or figures using which you develop the right hand side. You know the periodical interest payments, you know the yield to maturity or the return expected by investor, which is also referred as yield to maturity or the yield rate. Then you also know the redemption price and all this. This is one way of understanding it. There is one shortcut method which you would have done in your initial level of IPCC or PCC. You can use that also possibly, where the cost of debt or yield to maturity of a debt would be interest into 1 minus tax rate RP is redemption price, IP is issue price. So this is only an approximate equation. Cost of debt, what is popularly referred as KD. You would have read in your first level IPCC. Cost of debt calculation is done like this. KD is equal to interest into 1 minus tax rate, redemption price minus issue price by n. N is the number of the period of bond, which is 5 years here, the period of debt, divided by redemption plus issue price divided by 2. The yield to maturity or cost of debt is 13%. The expectation is 13% or yield to maturity is 13%. Therefore, the left hand side is 0.13. So this formula you already know. The interest periodically is 140. The interest periodically is 140. The tax rate is not given in the question. Tax rate is obviously relevant only for the issuer and not for the investor, or it may be relevant for the investor if interest is taxed. Notwithstanding this 1 minus tax rate, I just take 40, ignore this 1 minus tax rate because taxes are not to be considered, at least in this problem. Wherever you have the issue of valuation of bond, you might most of the times ignore taxes for the simple reason that a tax rate applicable to the investor may be anything. An investor could be a company or an individual, and therefore there is no single tax rate. So notwithstanding this or ignoring taxes, I just take 140. The redemption price could be 1000. The issue price is what we want, 1035.38. If you take the issue price as X and redemption price as 1000, this is X minus, this is what we want. The value of bond today could be the issue price. We want the issue price, X minus 1000 divided by 5, N is the period, whole divided by X plus 1000 divided by 2. Further proceeding. So I have taken the equation where we work out cost of debt. Cost of debt is equal to interest into 1 minus tax rate plus RP minus IP by N divided by RP plus IP by 2, where RP is the redemption price of the concerned debt, IP is the issue price of the concerned debt. This is an approximate equation. This equation is used to establish cost of debt, which is nothing but the yield for the investor, and therefore this is YTM, and that is 13%. All these figures are taken from the question at 140. 1000 is redemption price, X is what we are trying to understand, and the period of bond is 5 years. This is the denominator. Okay. Solving for X, this equation 0.13 plus 140 plus X by 5 minus 200 is equal to divided by X by 2 plus 500, that is 0.13 into X by 2 plus 500 is equal to 140 plus X by 5 minus 200. 0.13x by 2 plus 500 into 0.13, 65, is it 65? Is equal to 140 plus X by 5 minus 200. Taking all X at one place, 200, I bring this 200 over here, 200 plus 65 is minus 140 is equal to X by 5 minus 0.13x divided by 2. 265 minus 140 should be 125. 265 minus 140. This is X by 5 is 0.2x. 1 by 5 is 0.2. And this is 0.13 divided by 2 is 0.665 x. 0.13 divided by 2, 0.165. How much is that?
0.065.
Okay. 0.0665 x.
065.
065. Okay. That is 0.2x minus 0.05x. 200 minus 65 should be 135. Is it 0.13x? 0.2 minus 0.065? 0.135x is equal to 125. X would be 125 divided by 0.135. How much is this?
925.9.
925.9. The value of bond approximately is 925.9. The value of bond approximately is 925.9, but the value here is 1035.38. This figure that you derive by using this formula is an approximate figure and not the correct figure. If the redemption period is 5 years or 6 years, well known. If the redemption period is 15 years or 20 years, an approximate may be worked out, because the other method of finding out all the present values during the redemption period plus the redemption amount, all that would be difficult because the period is long. Now that it is only 5 years, instead of doing like this, it is better you do like this, because you get a figure of 1035.38 exhaustively rather than an understanding of 925.9. This is an approximate value, but this is the correct value, and therefore the correct method is to understand a figure of 1035.38. And therefore the value of bond, you can also use this, but this will give you an approximate figure like this only. So the value of bond that is asked for is 1035.38. Then the second problem is to understand if the price per bond is rupees 90 and the bond has a par value of 100, a coupon rate of 14% and a maturity period of 6 years, you are required, if that is the case, calculate its yield to maturity. It's something like this. In the last problem, we had 140, 1.13, then 140 divided by 1.13 to the power 2, etc. up to 140 divided by 1.13 to the power 5. plus 1000 divided by 1.13 to the power 5. We have calculated this and that seems to be 1035.38. All this added together is 1035.38. Now what is asked for here is price of the bond is 90. They have given this. The value of bond or price of bond is 1035.38. The value of bond or price of bond today is 90 and therefore they have given this, which means 90 is available. The par value is 100 and therefore presuming the bond is redeemed after 6 years at 100, the maturity value, the final value of 1000, here it is 100. It is after 6 years they redeem. The interest rate, coupon rate is 14% and therefore you will collect an interest of 14 for 6 years. An interest of 14 on 100 will be collected for 6 years. You are required to calculate this. Now in the last problem this is given, the yield to maturity or the return expected by investor is given. Therefore the investor is going to collect something like 140 for 5 years, 1000 in the 5th year. All these cash inflows expected by the investor are to be collected by the investor is discounted at his return expectation of 13%, that is at his yield of 13%, which is yield to maturity for the investor. If the investor purchases the bond at 1035.38, given the fact that he will collect 140 of interest and 1000 of income, he will get a yield of 13%. Now he is going to pay 90 today. He will collect 14 rupees for 6 years. He will also collect 100 at the end of 6th year. What is the yield to maturity? 1 plus R sort of thing. This is 1 plus 0.13. 0.13 is the yield to maturity or return expected by investor. This is what is expected. 1 plus R whole squared, 1 plus R to the power 3. Like that you have to proceed. This is 1 plus R power 6. This is also 1 plus R power 6. And therefore, the fundamental equation for value of a bond is worked out like this. 90, that is value today, is equal to 14 first interest discounted at investor's desired rate of return for 1 year. Then next 14 discounted for 2 years. Third 14 discounted for 3 years. Fourth 14 discounted for 4 years. Fifth again for 5 years. Sixth interest for 6th year for 6 years, plus the redemption price of 100, which is par value expected to be collected at the end of 5th year, is also discounted. So this is the yield rate where R is YTM or return expected by investor. So this is the equation which are required to solve. I would also explain this equation in a different manner. The value today is nothing but outflow for the investor. And these are inflows. 14, 14, 14 like that, 6 14s are inflows. 100 which is redemption amount is also an inflows. Now you are going to divide first 14 by 1 plus R, second 14 by 1 plus R for 2 years like that. Third year discount rate, fourth year discount rate. This R is not known, but these are all nothing but discount factors. Inflows discounted at R percentage. And therefore, there is an outflow on the left hand side. There are inflows on the right hand side. That is to be discounted at R%. Outflow is known, that is 90. Inflows are known, that is 14 for 6 years and 100 for 6th year end. R percentage is not known. If you look at this equation, this R you can obviously understand is IRR. R percentage is IRR of the above equation, where we are trying to understand or calculate a rate R whereby the present value of all inflows of 14 for 6 years and 100 for 6th year end discounted at R is equal to the outflow. Internal rate of return of cash flow streams of one outflow and 6 inflows of 14 every year and 100 at the end of 6th year. You are trying to have this equation in terms of outflows, inflows, where the missing figure R or the figure that you have to calculate of R is nothing but the discount rate, and that is what is popularly known as IRR. So the internal rate of return of this equation is R. Given outflow and inflow, you have to develop something like internal rate of return. Fine. There is one rate, that is coupon rate, available in the question. Let us presume 14% first. There is one rate of 14%, and therefore we will take 14% here. IRR is always worked out that R is YTM or R is IRR of the above equation. You will have to understand that possibly internal rate of return is always calculated based on trial and error method. Let us start with the rate that is given as 14% and try to work out the right hand side. At 14%, what is the value here? At 14% of R, the RHS would be equal to, I will look at it like this: 14 to be discounted at 14% over 6 years of time, and again 100 to be discounted at 6-year rate. If you take this as an annuity, PV of annuity of rupees 14 for 6 years at R is this figure, then PV of rupees 100 discounted for 6 years at R percentage. The right hand side is nothing but all these 14 are discounted for 1 year, 2 year, 3 year, 4 year, 5 year and 6 year. Therefore, this is taken as an annuity to be discounted for 6 years at R rate, and this is one single amount of 100 to be collected at the end of 6th year to be discounted at R percentage. Let us presume at 14% of R, if this is 14%, PV of annuity of rupees 14 for 6 years at 14% plus PV of rupees 100 discounted at 14% for 6 years. So this is one single amount. I go to the annuity table and pick 14%. From the annuity table, for 14%, the present value of annuity of rupee 1 for 14% over 6 years of time is 3.889, and therefore this would be 14 into 6.889, 3.889. Again 100 rupees to be collected at the end of 6th year. The discount factor relevant for 100 rupees at 14% is 0.456. How much is 14 into 3.889? 14 into 3.889?
54.446.
54.446 plus 100 into 0.456 is 45.6, and that is equal to the present value of annuity being interest receipt. 14 rupees is collected every year for 6 years. This is an annuity receipt for the investor. This annuity is discounted at R. We presumed R as 14%, that is one rate available in the question itself, and therefore I take 14%. I understand 14 rupees of annuity discounted for 6 years at 14%. The annuity factor for 14% 6 years is 3.889. 14 multiplied by 3.889 is value of this annuity of 14 over 6 years at 14%. Then 100 is one single redemption price to be received at the end of 6th year, and that value is 100 into 0.456. 54.446 plus 45.60 is 100.04. Now the total of all this discounted at 14% equals 100.04, and that is not 90. So this side should be equal to 90, and therefore 14% is not IRR. 14%, the R 14% is incorrect because this total is not equal to 90. I have to solve this equation where at a particular R the total of all this should be 90. It is not 90, it is 100.04. It is more than 90, 100.04. Therefore, I have to increase the discount rate. I have to increase the discount rate to ensure the present values become smaller. I started with 14%. Understand that it is 100. What I require is 90. The present value of all this should equal 90. Unless I increase the discount rate from 14%, I have to go to 15 or 16. Otherwise, this will not drop. So, to get this 100 to a figure of 90, to drop this 100 to a figure of 90, I need to increase the discount rate. The present values, if these incomes or cash flows, if discounted at more than 14%, will be in something less than 100 to me, and therefore I will take something like 16%. What happens if so I have tried at 14%. At 14% it is 100.04. I take 16%. If R is 16%, then the right hand side, PV of annuity of 14 6 years at 16% plus PV of one single amount of rupees 100, discount for 6 years at 16%. Like PV of an annuity of rupee 1 for 6 years, which is 3.899 for 14%. For 16%, the present value of an annuity for 16%, like 3.889, it is 3.589. So, this is PV of an annuity of rupee 1 discounted at 16%, which is and the period is 6 years, and therefore this is from the annuity table, present value of an annuity table, and that is 3.589. So, present value of all these 14 discounted at 16%, where the period is 6 years, is 14 into 3.589. Like that, 100 that you collect at the end of 6th year today would be based on a discount factor applicable for 16% for 6 years, and that is 0.41. How much is 14 into 3.589?
50.246.
50.246. I will take it as 50.25 plus 100 into 4.41 is 41, 91.25. So, this is very close to this figure of 90. I try to impute a figure of 16% for R. I presume R as 14%, I get 100.04, which is not obviously 90. I presume I am going to presume some other rate. The rate that I presume is something of a figure not being 14% but more than 14%, because this has to drop. As I increase the discount rate, the present values will drop. This 100 has to drop, and in fact to drop to 90, and therefore I can't take 14%. A rate higher than 14% has to be taken to ensure that this drops below 100 and perhaps dropping to 90. Therefore, I increase 14% to 16%. This is by trial and error. Can you try with 15? Yes, you can try with 15. I have taken 16. At 16, it is 91.25. It is almost close to this figure. You can say roughly the yield to maturity is approximately the yield to maturity. Approximately YTM is 16%, because the right hand side is equal to or closely equal to 90, or you can also interpolate, or by interpolation, when I interpolate, I do like this. At 14%, PV is 100.04. At 16%, the PV is 91.25. If you look into this, at some percentage, the PV has to be 90, because the left hand side is 90. I need a rate of R. If that rate is taken for discounting, I should get exactly 90. That is the IRR, and that is the yield to maturity. Therefore, I need exactly a rate by which this will become 90. At 14, it is 100.04 present values. At 16, the present value is 91.25. At some rate, it has to be 90. In fact, this is going to be something more than 16%. As you increase the discount rate, the present value drops. The present value drops to 91.25. The present value should further drop by 1.25, and therefore this will be something like 16.1 or 16.2 or whatever, which we can interpret and understand. I will do it like this. If you increase the discount rate by, or the PVs falls by the difference, 100.04 minus 91.25, what is the difference? 9, 7, is it 8.79? 100.04 minus 91.25. The present value drops by 8.79. If I increase the discount rate or the IRR is increased by 2%. If I increase the discount rate by 2%, 100 drops to 91.25, or 100 drops by 100.04 drops by 8.79. I would like the PV, which is 100.04, to drop not by 8.79 but by something more, 8.79 plus 1.25. 8.79 plus 1.25 is how much? 10.04. So this should drop by 10.04 and not by 8.79 to ensure that you get 90. So this is again an approximate, because time value of money do not drop proportionately. 8.75 is the drop when you increase the discount rate by 2%. The PV should drop by 10.4. The discount rate should be increased by how much? You have to solve this equation. That is, the drop should be 2 by 8.79 into 10.04. The interpolation equation, the PV comes down by 8.79. If I increase the discount rate to 2%, the PV should not come by 8.79. It should come down further by another 1.25, or the PV should drop by 10.04 to get this 90. What is the increase that you have to make to 14%? It can't be 2, it could be something more than 2. 2 by 8.79 into 10.04 is how much?
2.28.
2.28, and therefore from 14, don't increase this by 2%, but increase this by 2.28%. 14 plus 2.28% is 16.28, and therefore yield to maturity by interpolation is 16.28%. So this is an answer. This is also an answer. At 16%, I understand that as 91.25, which is very close to 90, and therefore I call yield to maturity as 16%. By interpolation, you have done for 14, you have done for 16. Both these figures are not 90. You need 90 here. 100 is something at 14%. When you increased it to 16%, it is 91.25. I should further increase that 16%. 14% increase to 16%, the PV dropped by 8.79. 14% should be increased to how many, by how many percentage, to ensure that 100.04 does not drop by 8.79 but drop by 10.04. 8.79 means 2% of increase. 10.04 means how many percentage increase over 14%, and that seems to be 2.28. By solving this interpolation equation with 14, I add 2.28 to generate an yield to maturity by interpolation at 16.28. This is right, this is also right, and both these are, this is one best approximate, this is also an approximate, both these are answers. Therefore yield to maturity could be 16 or 16.28. because of interpolation understanding you did generate this figure of 16.28. This is how you understand. In the first problem, value of bond, you have established the left hand side, given all the figures of right hand side. Right hand side, this was earlier something like 140 and this was 1000. In this problem, and the R was 13%. R was given as 13%, and therefore you have generated a figure of 1035.38 like that. In the second problem, this is available. The value of bond is given, and that is 90. The coupon payments are available. The redemption amount is also available. You are required to calculate R, which was earlier available at 13%. R here is 16 or 16.28. to 8%. The coupon rate is 14%. The coupon rate there is also 14%. Coupon rate is available. The IRR or the yield to maturity is available. Yield to maturity is asked for here. Clear? The value of bond is calculated here. The value of bond is available at 90. This is the value of bond today. Therefore, the missing figure here is R. The missing figure or the value to be calculated is value of bond, and that is 1035 points. So you must have to dwell upon this and this, understand the nuances of each problem, where in one problem we have calculated value of bond which is left hand side. In another problem left hand side is available. Most of the right hand side figures are available. R is what we calculate in the second problem.